Friend of mine called me with the problem. Not just any friend, it was a friend who teaches accounting at one of the best universities in the entire region, not just the city, but for like a multi-state area. And so this is a professor, an accounting professor, someone who has spent their career explaining how businesses work financially and how to keep track. Now, let's call my friend Susan. And she had an associate who did taxes, who in turn had a client. It's called the client Sam, who owned a manufacturing company. And the company was starting to have problems. The revenue was flat. Margins were going down steadily, and over the last couple of years, gone down a lot. And the bank balance was going down month after month. But their factory was literally running 24 hours a day, 7 days a week, absolutely full capacity. They couldn't make any more product. My friend, the accounting professor, had absolutely no idea how to solve this real life challenge. So I sat down with Sam, the business owner, and they hired me. And it took me about a week to get a feel for the situation. I started asking questions, not about the financials. Yep, I looked at the financials, reviewed them, but I started asking questions about the operation. And I walked through and I hit each department: sales, production, quality control, inventory management. When I went to production, I literally walked through the factory. There was absolutely nothing obvious. They were about as efficient as they could get. And then shipping. Like every other department, I asked a lot of questions. And I asked the shipping manager to walk me through a typical day. And their answer left me breathless, left me speechless. I couldn't fathom what I was hearing. And it took me repeated tries to make sure I understood what they were hearing. Every morning, the team loaded and put together the distributor orders first. They were big customers. They had large volumes and they were easy to ship. And those distributors paid 50 cents on the dollar when they bought something, half the retail price. The next, whatever was left over from the distributors, after that was packed and gone, the retailers got their orders. Now, retailers pay about 60 cents on the dollar. 10%, well, it's 20% more, but they have less margin than the distributors. And well, less margin for us, they get less margin, we get more margin, they get less margin. But finally, at the end of the day, if there's anything left over, the internet customers finally got whatever they could get. These were direct to consumer sales. It was full retail price, and every single penny of retail went out to these individual internet orders. So they were shipping their least profitable customers first every day, and it started a couple of years prior. When I showed the answer, when I showed the owner what was happening, his response wasn't, well, let's fix it. It was fear. He said the distributors would never accept partial shipments. He was absolutely certain and that he would lose their business if he shipped partial shipments, and he was not willing to ask those accounts. So I asked him one question, I'm going to repeat that. He said the distributors would never accept partial shipments. And he was certain, and he was not willing to risk losing these accounts by trying to ship partial shipments. So I asked him one question. How do you know they will reject this? Well, they just won't. They never have. But have you ever talked to them? Have you ever asked them if it's okay? No, I've never done that, but they won't. Well, ask them. And if you don't want to ask them, I will. We compromised. He didn't want me to call his distributors, but the sales manager made the calls. Every single distributor said yes. Everyone, not one pushed back, not one lost the count. Easy phone calls. The factory was running at 100% capacity, but yet the business was bleeding cash. We had an accounting professor who couldn't diagnose it, a tax professional who didn't want to touch it, and the solution was a conversation nobody ever bothered to even try to have. This is what cash flow advisory is all about. Here's what I want you to notice about that story. The problem was not on the balance sheet. You could sort of recognize the symptoms on the P&L. And it wasn't in any report that any accountant could ever produce for that company. It was buried in the operational assumption that nobody in finance had ever thought to question, because nobody in finance thought it was their job to question it. And an accounting professor who teaches accounting for a living didn't know where to start. I'm not telling you that to embarrass anyone. That's not their real name. I'm telling you that because it illustrates something really critical. There is a huge gap between what accounting tells you and what is actually happening to cash. I call it the clarity gap. And closing the gap is exactly what cash flow advisors do, and exactly what traditional accounting training does not prepare you to do. Today, I am going to present you with the complete framework, 5 pillars, each one builds on the last. And I'm going to show you exactly where Bill, who is sponsoring this episode of Cash Flow Confidence Live, where Bill fits into each pillar. Not as a magic solution to anything, but as an operational infrastructure that makes everything I'm about to teach you executable in the real world, not just the theoretical. It makes it executable in the real world, not just the theoretical world. If you only watch one episode to understand what Cash is Clear Advisory is all about, this is it. I'm David Safir, the founder of Cash is Clear Learning Systems, and this is Cash Flow Confidence Live. Let's talk about that cash flow framework. The Cash is Clear framework is built on 5 pillars. I call them the 5 M's. They are sequential, not suggestions, and they're not a buffet you get to pick and choose. Each one depends on the one before it. And it all starts with mindset. Pillar number 1, mindset, the foundation. Everything is built on this or collapses without it. Pillar number 2, model, a realistic picture of when and where cash comes into the company and out of the company each week for at least a quarter into the future. Model. Pillar number 3, manage, take action. Deliberate control of when money is going to be leaving the company and trying to control when money is coming in. Mentor. This is a step that is all about people and changing knowledge and changing ideas and changing attitudes, teaching clients to think and act differently, because data alone has never change a single behavior. It makes it interesting, but it is not an effective behavior change. So finally, the last pillar is maximize. Use cash as a strategic weapon, not just survival. And most accountants, when they decide to help a client with cash flow, they skip right to pillar number 3, let's manage. They run reports, they produce a graph or a chart or a dashboard, they deliver findings, they follow up, they encourage. But what happens? Nothing. They get frustrated, and because nothing's happening. And they wonder why they're not being taken seriously. Even if they really are being taken seriously, when nothing changes, they start to doubt it. But here's why it's not changing. They skip mindset, and without mindset, you're not an advisor. They skip model, and without a model, you're just guessing at the results. And they didn't learn how to mentor. This is a soft skill, not a hard skill. And it has nothing to do with numbers. Let's go deep into each pillar of the framework, and this framework will work if you let it. Pillar number 1, mindset. Go back to Sam, my client, for a moment. When I walked in, I didn't open a spreadsheet. I asked questions. I asked questions about how the business operated day to day, not what the numbers said, but what the people did. The shipping team was not making bad decisions because they were careless. They were making decisions that made perfect sense inside their own logic. You can ship hundreds of dollars to one distributor faster and easier than packing 50 individual orders. And they were optimizing for efficiency. The cost per unit to ship was much lower. And nobody ever told them that efficiency was not the objective. It was the wrong target they were aiming at. And nobody ever connected their daily decisions to cash and to profitability and what they were generating, or in this case, destroying by their simple order of how they were shipping. And that's not a mindset failure. It was a mindset failure, not a moral failure, not an accounting failure, a systems failure, the kind that doesn't show up on a report and never gets fixed by producing a better report. You could calculate the margins going to each of the distributors, but if you didn't actually see that order, it doesn't show up anywhere. And it showed up as fear. Sam was convinced that changing the priority would cost him his biggest accounts. That's how it started when he first picked up his first distributor. Ship them first. We got to make sure they're happy. And it kept rolling from there. And he never tested the assumption that sending the expensive products out, not the expensive for them, but the full price products out, wouldn't impact those distributors. He simply decided it was true. He was going to lose everything if he started to short ship the distributors or partial ship the distributors. And that's what he built his operation around. A fear, an assumption, a story he told himself years ago, and it just got calcified into unwritten policy. Nobody in accounting was going to find it because nobody in accounting was looking for it, and nobody in operations was going to find it because they didn't understand the financial side. You've got to tie the two together. Your job in pillar number 1 is to find those stories that have been put into concrete, those false stories, not with a checklist, but with questions. Deep, patient, open-minded questions that make a client feel heard and help them hear themselves clearly, maybe for the first time. And if you're uncomfortable asking questions and getting personal, get some help doing it, because organizations don't change until mindset shifts. Now, where does Bill fit into the mindset? No software fixes mindset. And anyone who tells you differently is selling an empty promise, but Bill removes the most common excuses for avoidance. Business owners avoid numbers not because they don't care, but because the numbers are hard to find, or they're hard to read, or they're scattered across systems that don't talk to each other. Bill consolidates payables, receivables, and cash flow data into a single dashboard with a single login. Real numbers, real time, no digging for data. And when the numbers are visible and plain, the key reason for avoidance is eliminated. The shift is exactly where the mindset conversion gets traction. That shift is exactly where the mindset conversation gets traction. Let's move on to pillar 2. Pillar 2, I need to say something really plainly. The standard financial reports that are produced every month by accountants all over the globe will not help predict cash flow. They are accounting records, an archive of the past, and the failure to distinguish between them and the past and the future is costing your clients real money right now. And the inability to say accounting is not cash, think about it again. You need to think cash, not accounting. It's costing your clients money right now. GAAP records revenue when it is earned. That's a legal distinction. Cash arrives when it is paid. That's the money in the bank, or the money in your hand, or the check when after it's cashed. You name it, there's lots of ways to get the money in the bank. That's when it's actually paid and the cash is there. So in a business with a 30-day receivable, these two realities are separated by 4 weeks if the clients pay on time. And it's separated by 5 weeks if they pay 36 days out, 6 weeks, 45 days. And it's 4 to 6 weeks during which the P&L looks really healthy, but the bank account is quietly heading towards zero. And the accountant sees profit, but the owner feels broke. And guess what? They're both right. And neither understands why. That is the clarity gap. It lives in the space between accrual accounting and cash reality. It also lives in the gap between cash accounting and cash reality. There are differences there as well. A cash flow model, a real cash flow model, works from cash moving in and out of bank accounts. It predicts through the integration of the income statement, the balance sheet, including cash reserves, including credit accounts where there's available credit, and accounts receivable aging, it's taking into account, and accounts payable aging together, not separately. One single forecast, a 13-week cash flow forecast, not a budget, a forecast. It's not the same thing. A budget's a plan. A forecast is what is actually going to happen to your cash based on what is already in motion. And for 1 to 2 weeks out, you can get nearly exact what's going to be happening. And weeks 3 to 9, it's reducing in accuracy every week. And by weeks 10 to 13, yes, they are educated projections. But it's far enough out to schedule payments and time negotiations and make decisions with data instead of gut instinct. And it's far enough out to get visibility into those big gotchas that happen to companies, those unexpected expenses, if you start getting visibility. So let's go back to Sam, the business owner. Sorry. Let's go back to Sam, the business owner. Once I built the cash flow model, we created a model that showed the impact of their shipping priorities. So I created a cash flow model and a separate model that showed the impact of priorities. And the math was absolutely brutal. Running the factory at 100% to serve a 50% or 50 cents on the dollar distributors or 50% margin distributors was killing them. And turning away full price internet customers was lost opportunity. And sometimes the internet orders got canceled because they went out and bought from a retailer. And sometimes retailers were canceling because they went to buy from a distributor. And so it was a downward cycle. We could see over time the shift. They were too busy losing money to make any. Now, Susan, the accounting professor, had access to all the reports the company produced, but she never saw it because the answer was not on the reports. Now, where does Bill's cash flow forecasting tool fit in? It creates a model, and it's free for customers who sync with QuickBooks Online, and it builds the baseline model automatically. It pulls historical data directly from the accounting software, no manual entry, no import errors, and the out-of-the-box charts can show cash history and forward projections in one place. And what if scenario engines give you the ability to model the decisions before you make them? Imagine being able to flip it and say, let's see what happens if we ship first to internet, then retail, and then distributors. You get to see what if. And what happens? Well, when a big customer pays 30 days late, run the scenario. Well, what does it mean to get a new contract to the 13-week forecast? You just model it in a few minutes. For an advisor, this is a client that now has a tool when they use Bill that works with you instead of against you. And conversations get a lot easier. Pillar 3, manage. Managing cash flow is not complicated. There's 2 levers: cash coming in, cash going out. Cash in, pull the cash in, and push the expenses out. It's all about timing. That's the entire discipline. Cash in, that is your single highest impact action in most businesses. And the single biggest impact there is fixing collections. Let me repeat. Cash in, the single biggest high impact action for most businesses is fixing collections. Not the product, not the marketing, collections. And I've had clients who had never once contacted a late paying customer to ask for a payment. And when they started making calls, friendly, professional, most of the past due receivables were paid within 3 weeks. This is not strategy. It's a tactical and execution of a tactic. Make some phone calls, send some emails if they'll respond, use text messages. Doesn't matter, whatever your communication method of your client is, that's how you want to communicate for late payments. The only thing stopping that client who never made the phone call is that nobody made it somebody's job. When I asked them about it, said, so what do the clients say? We had 3 senior people and they all looked at each other and said, who's making the phone calls? Nobody, everyone thought the other person was. Also on cash in, not all revenue deserves equal treatment. And we've talked about it already. The SAM was generating 3 very different cash levels from 3 different customer types. The same factory, the same product, the same labor, and the fix was the sequencing. They turned it around. Internet orders come first, retailers second, distributors last with whatever was remaining in their inventory. Now, there are 2 impacts on cash flow. One, we've already talked about. It's obvious. They're getting paid more for the same product. The second one was just getting the cash in. The internet customers paid with a credit card, and it took 2 to 3 days to get it cleared, to get it into the bank. That's it. Distributors paid by credit, and the distributors paid slower because they were the big guys, right? So they could pay you late. The retail clients, for the most part, paid on time. So you had a double whammy, even impacting more the cash flow for this small company. And I'll tell you, it was about $1.2 million in sales. So it's a small manufacturers. The same units shipped when we inverted the model, but the dramatically different revenue and the completely different cash in structure completely changed the profitability, but in this case, more important, it changed the cash availability. The profits went up, but we also saw it in the bank accounts going up. Now, how much did they invest? Zero. Well, they paid me and they paid me well, but I can tell you, they received 10x, 20x the what they were paying me the first month, and that continued not just for a year, but year after year. That's the benefit of being an advisor, is you're able to provide a return on their investment. They didn't invest more in infrastructure, they didn't invest more in advertising, they simply changed how they shipped. Cash out. So we just covered cash in. Let's talk about cash out. Most businesses pay vendors on the vendor's timeline, and that's okay. And when you have a 13-week forecast, you can pay on your timeline, because if you see shortages, you make conscious decisions to stop paying a bill, and you figure out which ones will have the least impact on your business. You can pay early when cash is strong and maybe earn a discount. Think about that. When's the last time you're told pay early? Well, I'm telling you, if you've got excess cash, that could be a huge win to get 2, 4, 5, 10% discounts paying early. Or if you don't have the cash and it's tight, you just stretch it out a few days and make sure you work on the relationship, assure people that it's going to get paid, and you don't break critical relationships. These are deliberate decisions, not passive reactions to whatever is in the bank account and whoever sent in an invoice this week. The uncomfortable truth is that some companies, and the uncomfortable truth is that some companies need to fire some of their customers. The distributor getting 50% off, paying in 60 days, and still complaining about shipments, if that happens, that's not a customer. That is not a customer that you want to work with. That is a liability with a purchase order. So where does Bill fit into manage? Bill automates cash in and cash out. And that matters because the primary reason cash management fails is not that people don't know what to do. It's that they don't do it consistently every week without fail. On the receivable side, professional invoices go out with automatic reminders. ACH, credit cards, instant payments go through a branded portal for Bill. It goes through a branded portal for the client's brand, and then customers can enroll in auto pay if they want to. And the I forgot and I lost the invoice excuses disappear when you're using Bill. Now, on the payable side, there's AI assisted invoice capture to get the invoices into the system. And sorry, I'm using notes. This is a lot to remember. So on the payable side, AI assisted invoice does do the capture, and there's a custom approval workflow. So people in your company can approve on depending on how much it is. You might get final say on the big invoices, but you don't want to have to deal with the small payments. Again, check ACH, virtual cards, international wires. They're all available to you, and a real-time view of scheduled cash outflows No mid-month surprises. That happens all the time. People get surprised. You stop getting the surprises. Here's the interesting part. Bill surveys their users, and those users save an average of 12 hours a month and over $10,000 per month every month. That is what happens when you replace manual, error-prone execution with automated, accurate, relentless execution every week without anything having to be remembered by anyone. Let's talk about pillar number 4, mentor. This is the hardest thing I can tell you about advisory work. You can do everything right, build a perfect model, identify every single problem that a company has, and design a complete, logical, well-documented solution, and your client implementation might not implement at all. Not because they disagree with you, but because change is hard, really hard. And information, no matter how accurate it is, no matter how clear it is, how well presented, has never been sufficient by itself to make people change. When I showed Sam exactly what was happening, numbers were right there, they were irrefutable. He didn't say, hey, let's fix it. He said he was afraid, but he had never tested the fear, never asked a distributor. He had decided it was true, and his entire operation was declining and protecting an assumption. And it was completely wrong. If I had walked in with a recommendations desk, just a bunch of slides or a spreadsheet, I would have gotten a polite nod and followed up email saying he needed to think about it. Instead, I asked one question: how do you know? And I offered to make the phone calls myself. That offer to make the phone calls changed everything. Not the data, it was the relationship that we had, and that I was willing to go out of my way to make the phone calls. That is mentoring, not delivering conclusions, not telling people what to do, but giving somebody their own clarity and then standing with them by their side while they act on it. The accountants who truly become irreplaceable are not the ones who produce the most sophisticated analysis. They're the ones who ask the best questions, who sit across from a business owner and say, with genuine curiosity, you can't fake it, curiosity with zero judgment, walk me through how this decision actually gets made. That question will tell you more about what's wrong than any report ever will. This pillar, mentoring, is the one no software replaces. No AI is replacing it. It justifies the premium fee that you will charge as an advisor. And it's the one that accounting training programs have never taught. They teach how to audit, which is the numbers, not about the mindset, not about how decisions were made. And it probably never will, because it's really tough to put on an exam. So how does Bill fit in to mentor? Bill creates a shared view of reality between the advisor and the client. And when both parties look at the same live data, same invoices, the same upcoming payments, the same 13-week trajectory, the conversation changes. You stop reviewing what happened last month and you start deciding together what to do next week. That shift from historian to co-pilot is the advisory relationship that clients actually want and almost never get. Bill's multi-user access with customizable permissions means the advisor can see everything and that the client sees what they want or need to see. Most clients don't want to see everything. The weekly meeting stops being a report delivery and starts being a coaching session. That's the difference between being a vendor and being indispensable. Pillar 5, maximize. The first 4 pillars, we're talking about solving a problem. This one's about creating something better. Once a business has the right mindset, has an accurate model, has disciplined cash management running consistently, and an advisor who's generally mentoring, they arrive somewhere most businesses never reach. The question no longer becomes, how do we survive next week? Are we going to have enough cash? When are we going to run out of cash? When are we going to have a surprise? It becomes the question of, what does our cash flow allow us to do? Sam's company started generating significantly more cash from the same capacity, from the same number of employees. And when we resequenced the shipping priority and rebuilt the model around profit and cash coming in, not client volume. Nothing new purchased, nobody hired. Same building, same equipment, same people, more cash. And then the conversation changed completely. We weren't talking about what the problems were. Now we were talking about what to do with the cash. That's the maximize conversation. Can we expand capacity? And the answer to that was yes. Ended up buying a new machine. These were $100,000 machines, and they were not something you go down. They're built in the factory. Expensive, time consuming to get in, but now they could afford it. What else? Can you pay a key supplier early and earn a discount that goes straight to the bottom line? And it makes your supplier really happy. Can you identify the 20% of customers generating 80% of the profit and build the entire strategy around replicating them? Maximizing means treating cash as a strategic asset, not just a scoreboard, not just something to be measured, going up and down. You price for profitability, not just volume. You reward employees on margin outcomes, not just on sales. You're asking the question for every dollar, is it working as hard as it possibly can? Most of your clients have never had this type of a conversation, not because they don't want it, but because nobody built the foundation that makes it possible. That's what the 5 pillars are for. First 4 are foundational, and 5, you get to start having fun. So where does Bill fit in maximize? At maximize, Bill shifts from an operational tool to strategic infrastructure. A new hire? All right, model the 13-week cash impact before the letter goes out. That new $100,000 piece of equipment, you model if you're financing it, what's the impact? Can you afford to pay part with cash and finance the rest? You model it out. An expansion of some other type, see what the cash happens, or a new contract. Run the scenario before and during the negotiations of a new contract. Bill's spend and expense management also becomes strategic to the infrastructure. It includes corporate card controls and real-time visibility, and it gives leadership a live view of discretionary spending. And that's a great place to go after once you've figured out root causes. You'll never fix big cash flow problems with discretionary spending. Combine that with Bill's reporting tools, and the advisor builds a cash management dashboard that tracks what actually matters. Bank balance trends, are they trending in the right direction? Receivable aging improvement, and payables managed strategically, not reactively. That's the financial operating system that allows a business to grow with intention, and an advisor to guide that growth with confidence. If this framework resonated to you, if you could see your clients somewhere in those 5 pillars, I want to give you something concrete to walk away with right now, something you can use to help them implement some strategies. I put together a free guide, Boost the Bottom Line, and these are 24 powerful cash flow strategies that you control. 24 actionable strategies from the full Cash is Clear system, ones you can start using with clients at your next meeting, and gives you a good taste for what it means to maximize, manage, etc. Download it at www.cic60.com. Don't worry about remembering it. It should be in the notes below, and you can find it there. Go out, work with your clients, and be the confident cash flow advisor that they want, need, and deserve. I'll see you next time.